Nikhil Khandelwal, Chairman and MD, Systematix Group. Nikhil, lovely chatting with you this morning. If you could, hear my previous question, do you think we've discounted all the global risks given the kind of sell-off we saw earlier in the week, or do you think there's more to come?
Hi, good morning. Well, I think in terms of the market, we have had almost since the good news of the US tariff getting sorted and the EU and the US trade agreements getting signed. There was a significant buoyancy in the market participants among the market participants. I think the entire technology related disruption, as well as in general the whole war kind of environment which is kind of picking up in the Middle East, that has kept everybody's the risk capital has been off the market. We believe that in general we are in a much better position as far as our business dynamics within the country, as well as our export potential of our businesses from India is concerned, and market is overreacting to a lot of things, which is happening across the world, and this is potentially we are entering towards the fag end of the kind of a poor market, and we expect that March may be showing us a new low, but I think from there on, market should be looking at much better momentum from there on.
Okay, so some more selling to come through in March, you're saying. Some more, and then perhaps after that, we'll see some bit of a pickup in the market. But you've said that the markets have been overreacting to a lot of news flow. Would you say that the markets have been reacting to the news flow around AI as well? Some are in wait and watch mode when it comes to IT, because they want to see how things really pan out. Even Nvidia CEO has said that the market is really not reading it correctly. What are your thoughts when it comes to this entire AI disruption and post the correction that we have seen in IT on a YTD basis, on a month-to-date basis, 20-25% kind of correction? Do you think valuations are looking much more palatable now, and it's a good time to look at these stocks on the basis of that?
Yeah. No, so IT, I think as a sector has been a laggard for a very long time. I'll say if you look at even from a 5-year perspective, the top IT stocks, the Infosys, the HCL Tech, the TCS haven't really generated significant returns for investor. If I'm not wrong, they have generated less than 8-9% on a 5-year absolute basis, while on a year-on-year basis, the stocks are down 15 to 20%. Also, in general, IT used to at one point of time have close to about 14% weightage of the index, and now which is down to about 11.5%. In our view, IT would continue to be would continue to be a I'll say underperformer as far as the markets is concerned. The weightage of IT in the overall indices is bound to go lower. I'll say the IT services weightage, while if in general, if there are other SaaS or fintech companies which slowly and steadily make way into the indices, that'll be a different case, but the IT services pack weightage is bound to go lower, and as a result of that, it will be kind of an underperformer to the markets. Having said that, in businesses of that scale and magnitude, they are trading at their lifetime low in terms of multiples. So there is trading possibilities. We believe that all the top 3-4 names provide significant trading uptick from these levels. The market does overreact on the AI related disruption on the sector. There is definitely disruption. There is definitely going to be impact on their business, but there are also going to be a lot of green shoots within their businesses. Nobody knows how it's going to play out. From a valuation perspective, we believe that these companies available at less than 15 time trailing earnings provide significant valuation upside, and which is more from a short term perspective. So from a 5 to 10% kind of a trading bet, one can look at IT, but from a long term, I think it will be an underperformer on the index.
Okay, long-term underperformer, but from a short-term perspective, it could be looked at as a trading bet for a 5 to 10% kind of an upside. Before I talk about certain pockets, I just want to understand, for us, India, of course, today is set to release a new GDP series with FY23 as the base year, and nominal GDP for the current fiscal is seen at around 8.4%. Could this reset earnings expectations going forward? What is your view? Because last time around when we had the GDP figure coming through, nominal GDP of 8.2% was extremely disappointing. How would you look at a figure of 8.4, 8.5% in terms of nominal GDP? Do you expect it to continue to pressure India Inc.?
Yeah, according to our assessment, we have just come out with a detailed note yesterday. According to our estimate, the revised methodology will lead to more realistic numbers as far as the GDP and other data is concerned. We believe that the surprises will be on the downside, so the GDP numbers, etc., will be lower than what we have been seeing. It will also be more reflective of what actually is happening on ground. There was a lot of discrepancy in terms of the data which we were seeing on the rural side, on the inflation side, and what was coming out of the GDP. A lot of that correction is being done in the new methodology, and the numbers will be on the on the lower side. It will be lower than what we have been seeing in terms of 8%, etc. Having said that, whether this will impact the markets and the market participants, I think markets and market participants have largely discounted the entire slowdown in the economy. If you see the overall revenue growth within the Nifty pack over the last 6 years, it's been just about 5 to 6%. It is clearly reflective of how the economic growth has been. So I think those kind of numbers will get recalibrated when we see the GDP number today. So the numbers will be on the downside. People will get a reality check. But having said that, I think the data about how the economy is doing, and the numbers have largely been discounted on the index. So shouldn't have a major reaction on the index. But we are in for a data on the lower side.
Data on the lower side. But in that sense, then what are the expectations in terms of earnings for the next fiscal?
Well,
A realistic
I think
one,
next,
for that matter.
yeah, no, of course. I think realistically we are looking at the next year being much better for the India Inc. Last year has been probably the most disruptive, especially led by the impact on due to the US tariffs and a lot of trade related disruptions globally. A lot of the companies actually saw significant unwinding of their inventory, which they were sitting on. It also led to a lot of disruption on the overall banking space. So we believe that this FY27, which is the next financial year, will throw out a double-digit earnings growth for the BSE 500. And for the Nifty, we believe that the earnings growth will be close to about 14-15%. We believe that major export-driven businesses from the automotive side, from industrial side, will see a significant uptick in their revenue and profit growth in the next financial year. We believe that the banking sector will also show close to 12 to 13% advances growth next year, and we will also see a fair bit of consumer-driven earnings growth as well, which hasn't come in a big way in this financial year due to some inflationary pressures. So a combination of that, the next year earnings growth for us for Nifty is about 14 to 15%, and for the larger BSE 500 is about 13 to 14%.
Okay, at least somewhere around the mid double digit mark. But when you said that consumption, perhaps the earnings could see a comeback. Would you be talking about the discretionary end, or would you be more tilted towards staples?
No, so I actually, the growth is across the spectrum. According to us, there is the premiumization theme within the discretionary consumption pack will continue to play well. There is significant capital sitting in the rural and the tier two tier two households, and that will continue to be a big growth driver for consumer pack in general. There is the staples as a pack. We believe that under penetrated categories, or categories which are seeing more move from unorganized to organized, like for example dairy as a pack, for example, the
Hmm.
packaged spices as a category. I think these pockets, although they are small, will be more disruptive, will be seeing significant growth, even for a player like ITC and Unilever, etc. These packs will show faster growth. But the overall
Hmm.
weightage for us will be on the discretionary space, where we believe that as the discretionary pool of companies like the Titans,
Hmm.
the retail brands, etc., they continue to expand their footprint
Sure.
beyond the metros into tier one and tier two cities. There, they will show significant momentum in their profits and revenue growth in the next few years.
All right. Okay. Discretionary spending, of course, is picking up, and that's where you guys are also bullish. But last question, really, if you had to pick something within the BFSI space, PSU banks, like private lenders, life insurance, small finance banks, where is the risk reward looking more compelling over the next 12 to 18 months? And which end of the spectrum would you be looking at within the space?
Right. I think so. As a BFSI, as a pack, we are seeing that the among the larger banks, the balance sheet strength is actually at its best. The ROAs for PSU banks, the large PSU banks, is in the range of 1.1 to 1.5%, while they trade at less than one time book value in most of the cases. In private banks, also ICICI and Axis, which are our preferred picks, are trading at close to two-time book, while their ROAs also are in the 2.5% range. So definitely among the larger private
Hmm.
as well as public sector banks, we have preferred picks, and we believe that they will be good. They'll be outperformers as far as market and in general the financial pack is concerned. But we believe that the maximum
Hmm.
alpha will be generated in the small finance bank pack. The besides the
Okay.
general credit growth which we are seeing in the entire financial sector, the small finance banks in general are actually seeing a significant uptick in their margins. They are actually expanding on their other income growth driven by credit card and home finance, etc. They are also
Hmm.
significantly moved from unsecured to secured lending, which is going to which will drive significant, valuation uptick for them, significant ROA improvement for them. And these banks are also,
Hmm.
becoming geographically well diversified from being a regional play. So a combination of those factors and them trading at less than one and a half time book provide significant
Hmm.
conviction that these banks will outperform the entire financial stack. So from large bank like AU Finance
Okay.
to Ujjivan, Equitas, or even a smaller name like Capital Small Finance Bank, we are bullish on the entire pack.
Okay, this was supposed to be my last question, but since you mentioned AU Small, the recent, the developments with IDFC First, small, even for AU Small, do you think that won't dent sentiment when it comes to smaller banks?
Uh, no, actually, these banks are, I'll say, first of all, this IDFC Bank episode was kind of an issue created by lack of oversight, and of course more about a few individuals who created the issue for the bank, and what led to that entire kind of a fraud, which is being investigated. But in general, I think the banking sector, most of these, at least the small finance banks, are driven by very strong promoters. B, I'm sorry. So, secondly, I think
No worries.
the entire technology stack within these banks provide for these kind of issues to be well taken care of. So, we feel that some of these issues continue to happen in the lending space, not just in financial in banks, but also in NBFCs. They have put enough checks and balances. I think IDFC issue is an unfortunate event, but we don't believe that will lead to a significant issue or overhang
Okay.
on the banking sector in general.
Sure, isolated incident and not really a systemic risk, as has also been pointed out by the regulator itself. But with that, Nikhil, would like to thank you. Appreciate your joining in. Always a pleasure. Have a great day ahead.
Thank you. You too. Bye.
Well, thank you.